Okay, folks, welcome back. This is our midweek review for week ending January 17th, 2020. Okay, so the remainder of the economic calendar for this week. Tomorrow we have the ECB monetary policy meeting accounts at 7:30 a.m. during the New York session, so there's going to be a lot of volatility for Euro as a result of that, and 8:30 a.m. core retail sales for the dollar index, high impact. So Thursday's New York session is going to be very busy, so prepare for that. And then closing out this trading week on Friday, we have the GBP high impact retail sales for London, and 8:30 a.m. building permits, medium impact, dollar-based consumer sentiment, and treasury currency report. The lesson for this midweek is going to be institutional levels and SMT. It will be basically a review on the Aussie dollar that I outlined on Twitter. Okay, so here's our daily chart of the dollar index. And as I mentioned over the weekend, we had a BISI in here, buy side imbalance, sell side inefficiency. In the form of a fair value gap, we would likely see it trade down into that. It's been respecting the bearish order block thus far, and this would be reasonable to see it come back down into here, close that up, and then potentially, I don't know if it's going to do it or not, but we'll see if there's any kind of support here to make an attempt to get back above that 2018 high, and then therefore reach for the buy side liquidity pool. I'm not opposed to seeing this fair value gap give way and resume going lower to attack the sell side liquidity. It just, on the near term, I've allowed for, because of January, I'm not trying to be in a trade. I'm not trying to be 100%. I'm observing. I'm trying to get a feel for what sentiment they're working on. And when I say that, what I'm saying is, at the beginning of the year, there's a lot of money that sits on the sidelines and starts pouring in gradually. Okay, and large funds will start to work their positions in based on their analysis. Their fundamental departments will be pushing them to be doing certain things, and we allow for that in the entire month of January. We're not in a hurry to get out there and do something. Now, it doesn't mean we can't practice using lower time frames. It just means that we don't commit to a bias, at least on a higher time frame. Okay, and there, like I said, there's going to be times where the market just tears off and does some amazing things in January, but I don't see it happening this January. Okay, and for the most part, as a general rule of thumb, it's probably not going to be the case either. So just be mindful that we're watching the fair value gap. We want to see it support. Okay, if we see it break away, in other words, if we lose the fair value gap and it goes lower, okay, what does that mean? Well, to me, I think it means that it's most likely too heavy to support a run to the buy side liquidity, and we're going to make an attempt to get back below here. Now, if we get below here, the 96.40 low, then it'll probably be an aggressive sell-off for dollar and attack the sell side liquidity here, because we have layered sell side here and relative equal lows over here as well. I'm giving it the benefit of the doubt, and we'll see what happens. Trump mentioned and signed the first phase of the China trade deal. That may be something of importance for the dollar. That may spur some central bank repricing on the higher side for dollar after it draws down lower, again lulling traders into a bearish sentiment. That's one scenario I'm looking at, but I still have not ruled out the run to the buy side liquidity pool here. Okay, I just want to be made very clear going forward. I hold no real bias that would put me into a trade. Okay, otherwise I wouldn't be in here trading. Moving into the hourly chart for the dollar index, this is that fair value gap just transposed onto the hourly chart, and the levels we had mentioned over the weekend, 97.20 institutional, and then we had a fair value gap down here which closes essentially at 97.06. That would also take us just below these relative equal highs, where retail will be looking for that as a potential resistance broken support, and we'll be looking at the fair value gap, which would be just below that a little bit. And we don't want to see, for the near term bulls, we don't want to see this level 97.06 give way. It needs to be supported if not at 97.20 altogether. Big pool of liquidity forming here. Too clean, in my opinion. So it's suspect. Dropping down into a 15-minute time frame for the dollar index, we can see we have today's price action. Yesterday we had a really nice run above Monday's high, and turtle soup or failure swing breaks down. Very, very nice SIBI, fair value gap, sell side imbalance, buy side inefficiency, consequent encroachment, sells off, bearish order block, no fair value gap. So when price moves lower, it returns back to the bearish order block after running buy sell liquidity for Wednesday's trading. Creating a breaker, buy sell liquidity pool ran out during London. The low in between the previous late New York session highs and the low in Asia for Wednesday's trading. That is the last down close candles, making the bearish ICT breaker. Mean threshold of the bearish breaker. Majority of the SIBI, sell side imbalance, buy side inefficiency, has been rebalanced here, and then we break lower, creating a fair value gap as well. Beautiful consequent encroachment, midpoint of this fair value gap. Price sells off one more time. These lows in here, I'm not comfortable with those. I think we'll probably end up going lower. These equal lows don't jive with me. I think we'll probably want to run those out, which would also send us down to that 97.10, 97.06 level. And again, that's going to be the level that should be kept intact. In other words, we don't want to see it breach that. If we go below 97, the buy side liquidity pool on the daily chart for the dollar index moves off of the horizon for the near term for me, and then we focus on that daily sell side liquidity pool. All right, so here's our euro dollar daily chart, and we traded back up into the bearish order block in here, and I want to see it essentially stay below these relative equal highs here. We ran above it. If we swipe it one more time and then reject and go lower, that's a possible scenario. To me, this is what I'm looking at, okay? I'm looking at these lows here, low, 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 and higher lows, higher highs, higher lows, higher highs, all that business. It just looks too perfect for a trend line support diagonal basis. I don't have any faith in those types of things. I like the fact that we had all these multiple attempts to get up here, and now couple that with the economic calendar for tomorrow's New York session. They could pump this up a little bit more, send it up into mean threshold of bearish order block, which is also, interestingly enough, overlap of the buy side liquidity pool at these relative equal highs. So to me, I think that 111.80 could be seen again. How we trade at 111.80 is going to set the tone for the remainder of the month. Again, coupled with tomorrow's ECB high impact news at 7:30 a.m. in the New York session. I don't want to be a buyer of euro. Okay, I don't trust it going in, but that could change tomorrow based on what we see ahead of the ECB, and also a few moments after that. Okay, 15 to 30 minutes after whatever news hits as a result of that. If we have some imbalances, then we can probably work in that in practice. But we're not trying to commit a hard bias yet. Okay, so right now we're just observing, collecting intel, and waiting for more information. The euro dollar 60-minute 1 hour chart. Okay, we're looking at today's price action here. Now, this is what I wanted to bring to your attention, because if you remember, and let me go back to the daily chart. This fair value gap, I told you I was going to leave those lines on here for a while. Okay, and the reason why it's on here for this long is because we are in a long-term consolidation for euro. Okay, so this imbalance in here on the daily chart, these levels are going to be remembered by IPTA. Now we go into an hourly chart, you can see that's the high of the fair value gap, and this is the low of the fair value gap. Okay, we have relative equal lows going into Monday's trading. Sunday's trading here creates the Equal lows on Monday. We have sell side liquidity. This in here will be more clear when we drop into the 15-minute time frame. But we do have a BISI in here with the sell side liquidity pool. Price drops down into that during the trading on Thursday. Then we rally. And then this is what I want you to take a look at here, okay? Price drops one more time into the top of that old daily fair value gap. Now, it doesn't look all that sensitive in here, but that's what it's trading off of. Okay, it's trading off of that, plus it's coupled with 111.20 institutional level. Then attacks the buy side liquidity pool, resting above these relative equal highs, and that's what we get today for Wednesday's trading. Let's drop down into the 15-minute time frame. Here's that buy side liquidity pool and the sell side liquidity pool, and here is that small little tiny fair value gap. And wouldn't you know it, like magic, abracadabra. Look at that. Really, really nice run here. Just a bit below consequent encroachment between the high of the fair value gap and the low of the fair value gap on that daily chart. Look at the sensitivity here. Look at the bodies of the candles, okay? Yes, we get a little bit of a tail here, a little bit longer tail here, but the bodies and the bulk of the volume is being supported with the top of that fair value gap. Price runs up, comes back down, rebalances again in here, and then sends it off to the races for the buy side liquidity pool. Beautiful, beautiful delivery of price. Now I'm going to remove the fair value gap lines on the daily charts. In other words, these levels here, I'm going to remove them as of today. They no longer will be on the chart, but you're welcome to keep them on there and study them going forward should we trade back to it. In fact, I'm going to encourage you to do so, but I want to take it off my charts because it's going to steal the thunder from other things, and if it's interesting or salient, I'll bring it back up again, but for now, we've pretty much exhausted it. So if we look at the low here and a high, we got basically almost an optimal trade entry. I haven't ran a fib on it really to see it, but we did break the equilibrium from high to low, so that would be, again, a very low risk, high probability scenario, coupled with a higher time frame IPTA PD array. In other words, the top of the fair value gap that's it's basically expired, okay, in other people's eyes for any kind of imbalance, rebalance scenario. Okay, a la Chris Laurie. I'll just say it like that. I'm not trying to be disrespectful. I'm just saying that once that filled in for him and his group, he would most likely, okay, I haven't checked with him. I haven't heard him talk about it, but I'm quite certain that he would be considered done with that one. This is what makes me different from him, okay? Just like I talk about many times, the distinctions between myself and the supply and demand guys, okay? Sam and his zones. I don't teach supply and demand, okay? I teach institutional order flow, order blocks, and IPTA. So I'll cut through candles. I'll do other things that all these other guys say that are rules for their theory and their system, and it completely removes the opportunity for them to see the real narrative that is the underpinnings of the market. So I want you to study this here and look at the amount of pips that we offered here. Over 40 pips from the top of the fair value gap here. From here to here, that's optimal trade entry. Small little imbalance. Look at the small little imbalance in there. It's not much, but look at the sensitivity. Beautiful. If you don't see that with the mean threshold of the S down closed candle here, which is the bullish order block, you have everything right there. Beautiful. And expansion to the upside, clearing the buy side liquidity pool. If you want to keep the fair value gap lines on your chart, just take them to a color and thickness that's like faint. That way you'll see it when you're going through your lower time frames, but you're not trying to have your attention fixed on just those levels alone and not see what else is being made available to you. Okay, cable. This is our daily chart, and I had a fair value gap outlined for you guys over the weekend and the likelihood of seeing it trade lower. The only thing I did was adjusted another level for discount, which is the order block in here. I'm not going to put the mean threshold in here, but essentially that's what it traded to here, because otherwise the chart would be really busy. And we want to see price trade higher going into London tonight. Now, how much of a rally, I don't know. This one's kind of like a wild card, but the news really is euro dollar. So we'll see maybe some sensitivity and some, I guess some sympathy play. If euro really takes off, cable will probably go with it. Dropping into the 60-minute time frame, this is that fair value gap. Inside that fair value gap from the daily, this is the blue shaded area. That's the fair value gap on the daily. We have an imbalance in here. That's likely to shoot that up in here, and we'll probably see that through Asia tonight. If we run through that and then come back down, find support at the top of the gap, it doesn't need to do that part, but if it does, we're probably going to come all the way back up into here to this bearish order block and the remaining portion of this SIBI, running out the relative equal highs in here. So just watch 131 overnight tonight. 131 may be a upside draw, and then what we get with ECB tomorrow, that'll probably be the continuation going into Friday. Whatever narrative is exposed at 7:30 a.m. tomorrow for euro will probably be sympathetic trading in cable as a result. Relative equal lows on Monday. We ran those out on Tuesday. Breaking market structure, comes back down. Small little run back into the mean threshold of this candle here, right here. And then we found, again, the daily bullish order block. Nice sensitivity there as well. And then we start to expand. Just too clean in here. I think we're going to expand, at least, again, going into Asia, maybe into London. If we get really wildly bullish and run up outside of that fair value gap, this is where I'm looking at here. Relative equal highs and the bearish order block over here. And I don't know if we'll get above that. And to be honest with you, my focus is primarily on euro dollar going into tomorrow. 15-minute time frame for GBP. And you can see the imbalances here. Again, the daily bullish order block is that line here. Fair value gap in the form of a BISI comes down, hits the bullish order block, and also consequent encroachment of the fair value gap. Beautiful overlap there. Spends multiple times in that, and then expands up, creates another fair value gap in the form of a BISI, buy side imbalance, sell side inefficiency. Beautiful 100% return to the pip, and then expands on the upside. And we're just having a small little retracement here and returning back into a bullish order block here. So this should really send this higher. So at the time of this recording, I don't know what it's going to do in Asia, but I would venture to say it's probably going to be bullish. And we have the SIBI here as well. Relative equal highs. And then that remaining SIBI that need to be rebalanced at 131.01. So basically 131 big figure should we get really extrapolated on the upside. Okay, so our IPTA price action lesson for the midweek review. Obviously, you guys seen on Twitter today, I called the Aussie dollar New York session reversal. And I kind of want to go over some of the salient points that led me to believe that that was going to happen, and why my focus was here versus the euro dollar or cable. And as you can see, it's pretty punchy, pretty explosive, even for a small range move, but it was very, very reactionary on the things I'm going to talk about. So again, I shared this on Twitter. It's not that big of a deal, but some of the things I'm going to cover now and fill in the gaps that I purposely put in my public commentary or drawing your attention to it. I got an email, just so you know. And again, I'm not rehashing this to beat the individual up. I understand the concern, but I'm a teacher at heart. Okay, and yes, I do some marketing through Twitter. Maybe most of you would probably say it's a lot of marketing, but nonetheless, I'm still talking to you as well. And I'm prompting your attention to certain things. And then you have the benefit of coming into these recordings and watching all the things that I'm not willing to share publicly. So that's mentorship. I will get them close to certain things because of free tutorial level, but I'm not going to give them the details that led to and explain, like some of them even asked today. They said, hey, look, can you give us a video? No, I'm not. That's the purpose of a mentorship. So I'm going to continue doing that. So if that bothers you, just know that you're getting the highest form of the education side. These other individuals on the outside, all I'm trying to do is inspire them. And granted, 90% of them, they're never going to join the mentorship, okay, when they see it, because they feel that the free membership stuff should be enough. And I would agree that it is. It certainly is. But there's always going to be this insatiable appetite that's created by those free tutorials, and mentorship is where that gets completed. So let's take a look at this and get a better view of what took place here. And I'm showing you the USDX SMT, and that, I guess it's orange. I'm not sure if it's orange for you, but it looks orange to me. It's the dollar index, or Dixie, and I just basically overlapped or overlaid it with the compare function on TradingView, and I mentioned that before. And then when it does overlap and posts the compare, it will post whatever instrument you're adding to your chart in comparison in the form of a line chart. And all I did was change the candlestick chart for Australian dollar to a line chart. So now we're seeing the Aussie dollar, which it traded back up into that bearish order block. Okay, this is what I was prompting everybody to watch. Everyone's familiar with seeing it come back up, close up the inefficiency here, and then optimal trade entry and go lower. Okay, if I were to poll everyone, and see, here's what I did not want to do. I didn't want to poll anyone and kind of like prime their understanding by asking questions like, do you think it's going to go below this low and continue going lower, or do you think it's going to go down below that low and then reverse? See, because if I do that, I'm indirectly teaching, because there's a very large group of sharp individuals that can pick up when I'm dropping down some subtleties. Okay, so only thing I wanted to do was show it as it happened, and then right after it hit the low, that's when I showed the recording, saying, okay, we've purged the lows, and everyone's eye should have been in that fractal, okay, with the relative equal highs. Okay, everyone that does not know mentorship, or that runs on liquidity, low resistance liquidity runs, and then market reversal profiles, would have expected this run above these equal highs. That's what they were all primarily looking for. Only a few of them were expecting this return and then go lower, but the ones that were doing that didn't expect the reversal. They wanted to see it keep going. Okay, so go back and look at the Twitter, and you'll see this. Again, we're not trying to make fun of anyone. We're not trying to fault anyone. And if it's anyone in the mentorship, I'm not trying to do that. What I'm trying to show you is there isn't this group of people, okay, and there's one guy out there pretending he's figured it all out now. He has not. But nonetheless, the market reversal profile was framed with this context. Okay, so we had a long period of consolidation in here, and we had an initial run overnight, then a retracement during the New York session, back up into a bearish order block as I outlined. We did have a liquidity pool here, and layered liquidity pool here, and then we have layered here, and then a small one as well. This dropped down during London. This is your SIBI, sell side imbalance, buy side inefficiency. It runs a shallow run below this low, and then it comes back up during the New York session multiple times, okay, coming in here deeper, 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 and then they send it aggressively lower, running the sell side liquidity out more convincingly, so it's a much more pronounced drop lower. If you go back and listen to what I showed and described on the weekend review about the dollar and its daily chart and that fair value gap, the likelihood of it dropping for the dollar, that was what we were most likely going to see going into Monday, Tuesday, early week. It didn't happen until essentially today. So I watched that, and then as I showed with the previous slide here with the USDX SMT divergence, the lower low here as we were running the liquidity out and hitting an institutional level 80, SMT with institutional 80, plus the fact that we had the dollar going soft going into its daily fair value gap, reaching for a lower discount array, that sets the tone for a market reversal profile. And then we had that surge here. Now, again, I'm showing the chart and the recording here, okay, saying, okay, yeah, we've purged the liquidity, okay? All this is gone now. Whenever I say purged, okay, whether I'm in the mentorship or if I make light of something in a specific liquidity pool, and if I say the word purged, that's kind of like a prompt to you to expect a market reversal profile, okay? Or at the very minimum, return back to equilibrium, okay? So in other words, we're not looking for a layered run or a layered low resistance liquidity run where this would be one target, this would be target 2, target 3, target 4. We're not looking for that scenario. We're looking for a run on liquidity, purge it, okay, and that's going to be pairing orders. Then we'll expect the market to run higher. So the initial run back to the order block here, that's your short. So if you're scalping, you could sell short here, buy it back below the low, and then buy more to go long. If you don't catch that, that's fine. Don't worry about it. When we get back up into this level here, you're going to be convinced that it's going to run aggressively because we've had such a real quick displacement to the upside. There's no necessity for it to go back down again here because we've already cleared the stops. So inside this shaded area, that's your bullish breaker. So you're going to be able to buy and accumulate your long position inside this area just like the banks did. We're not waiting for a retracement to come back down to the fair value gap. There's no necessity for that. Why? This is a balanced price range. Strong delivery down, strong delivery up. There's no reason to come back down into here with the narrative of the low being taken out, and then we have the very clear indication that smart money's on the move because the dollar index was unable to make a higher high when this pair made a lower low. So all of the fingerprints were on this pair today, at least for the New York session, and accumulation was seen here, and then we had the expansion on the upside, and I want to explain all this lipstick in here to you, okay? The low risk, which, you know, obviously you have to learn how to do these things, but that's the benefit of what you're learning here. You're going through the motions of going through the processes and learning what makes a market reversal profile. This in here is the low risk entry, but it's also the most fearful. Okay, you're going to be scared to do it. That's why you have to do this in demo. That's the reason why you do it in a demo, because you condition yourself with these, I guess, attributes that make a market reversal profile likely to unfold. Again, New York session, this is the scenario that you would, it's like the perfect scenario, really. The market expands up aggressively and then pauses inside the breaker. You don't have to wait for it to retrace going lower. You can accumulate right in here and go long with the expectation. And you want to kind of like get it as it's going down, any kind of movement down, preferably inside of the lower half of the breaker. So all these up close candles, that's what I'm indicating with this green box. Split that in half. As long as you're buying at or below that, you're in a discount market without having to go all the way back down to here or even to the fair value gap, which isn't a fair value gap. Everyone else that thinks they understand fair value gap, they're looking at this down here. Oh yeah, ICT is going to buy down here. No, I'm not. I wouldn't do that. It's balanced in here because it's already ran the stops. This is not a fair value gap. Price expands up, hits the big figure. Okay, now what can we do? We anticipate a run past the big figure, but how much? Well, look at the big figure and then look to the left. We see a buy-side liquidity pool here. That's way too shallow. Then we have a buy-side liquidity pool here. That's much more meaningful. It's also at the 10 level. 10 is an institutional level. 90 is an institutional level. 80 is an institutional, major institutional. 90 is a minor institutional. Major, big figure, 6900 level, big figure. When we cross that, protocols suggest a potential run of 30 to 40 pips. So it may not just go above a little bit. It could go a lot, return back, rebalance, and then go higher again. What I'm suggesting here is the price, once it gets to the big figure, it's going to spool and reach for buy-side liquidity. But you have to look through price action to see where those highs are, where the liquidity would be resting. So it's a visual approach Plus, it's also an incremental approach. So when we get to specific levels like the big figure, 69.00, right away you should think, okay, minimum, we should see 69.10. So is there anything that overlaps with 69.10 to the left? Yes, we have a buy-sell liquidity pool resting right there. Then, if we go 15 pips, because remember, it's not just 10 pips, it's 5, 15, 25, or 10, 20, 30. But then we have an additional likelihood when we cross a big figure that it can go 40 pips. So we don't just stick to the standard 30 pips maximum, it could go potentially 40 pips. So if we go 20 pips, that takes us up to 69.20 naturally. And we also have a buy-sell liquidity pool there. So I want to see tonight if we get any further weakness on dollar, if it goes down to, say, that lower level fair value gap on the hourly chart. If we get down there, that might constitute a run to the 69.20 level for Aussie dollar tonight in Asia going into London. And we'll see if that happens. We don't want to see, or the bulls don't want to see, rather, a move back below the mean threshold of this bullish ICT breaker. So more or less 68.95 is the line in the sand. Bulls don't want to go below that. So if IPTA takes it below there, we're probably going to be back into a mixed scenario and or moving aggressively lower over the course of next week and higher for dollar. And again, that would be some things that have to line up together. Don't just listen to these commentaries and hear me say things like that and say, okay, ICT said it's going to aggressively sell off next week for Aussie dollar. I just gave you specific things that have to agree. That's algorithmic. They have to align. If not, there is no setup. There is no likelihood for that to unfold. Okay. So we've seen a market reversal profile here. I outlined it on Twitter. I walked you through it. I drew your attention to it. The people in public don't know what I'm talking about. They see pieces of it and they're still flabbergasted. But you can see the level of precision because of the elements that I'm teaching you. And this is not just pulling things out of the air. These are all very specific things that are taught in core content. Okay. Plus, I spice it up a little bit with some charter level lingo. But I feel that if you study the market reversal profile like this, find instances where there's a strong reaction and reversal in New York sessions. Okay, so that's why it's important to focus on New York. Even if you think primarily you're going to be focusing your model on London as your session of choice, it's real imperative that you study the New York sessions because of the signatures that offer early warning signs of a market reversal profile. Because you could have been selling short here or short from back over here the previous day and this run here, and then you're thinking, okay, well, I'm going to load up and add more. And then when it starts to drop down here, you think that you're sliding into home, it's going to go below 68.50 and thereabouts. It's not, because it's giving you every indication that it's going to reverse. So it may not be a long-term reversal or intermediate-term reversal, but it's enough to shake you out of a short and turn your winning trade into a losing trade. And we don't like to do that. When a trade moves into a winner's bracket, we want to be reducing risk, and then ultimately removing the risk in the form of our stop. Now, it doesn't mean that you have zero risk anymore, because the markets can gap through stops. There's always risk until you collapse the trade. When you're in sidelines, that's the only time that you have zero risk. If you're in the market, your stop loss is not a guarantee of protection, but it's the only form or shield, if you will, of protecting us. And that's it. That's the business. So if it scares you, then you're probably not going to be a trader now, are you? But you have to consider what you're risking. And I believe if you study this and use it as a model going forward, looking at New York session reversals, you'll see that this is the signature that repeats 95% of the time. So hopefully you've gotten some insight out of this, and I will touch base with you again through Twitter tomorrow, I'm certain, in the New York session. And until I talk to you this weekend, Saturday, at 5 o'clock, I should have the weekend edition. Again, if not sooner, but give me at least till 5 o'clock Saturday afternoon for the weekend ICT mentorship commentary. If you don't see me because of your own personal schedule by way of Twitter, enjoy your weekend, be safe, and I'll catch up with you on Saturday.